Good afternoon and welcome to the TheoTrade Afternoon video. I'm Blake Young and today is June 18th, 2025. We had a Fed meeting today. We've got war going on. We've got high inflation. We've got lack of growth. We have GDP going negative. It is a volatile, crazy market. And yet, while we're seeing all this, there's going to be opportunities. So with the fact that we have bombs flying in the Middle East, the fact that we have inflation still strong and yet lack of growth, so stagflation-esque behavior, and a Federal Reserve that has decided to tell us that they're not only not cutting rates, but they're probably not cutting rates in 2025, would seem to point to a hawkish Fed in a non-hawkish economy. So we've got a lot of conflict, which generally will tell me I want to look for safety, defensive plays. To start with, we can see that S&P 500 has been stuck up here near this high. This is short from the previous highs, and we've traded at roughly the same level all the way back into May. So May 19th, and then again and again and again. We've traded 10 out of 13 days have tested the same 590 to 600 level in the S&P 500. It's showing us that we don't have a lot of lift. No matter whether the volume is up or down on average, we are not getting the lift that we would expect in conjunction with a bullish market. So it does feel like we're kind of topping out. And in a normal market, in a bullish market, you can just buy the big tickers. You can buy the Magnificent Seven or buy MAX or buy SPY. But reality is that makes you look like a genius in a really strong bull market, but now's not that time. So as we're watching the lack of strength, the lack of movement into the S&P 500, we can also see the same thing in the lack in movement strength into the QQQ. Again, these are just warnings. And you can see that we're at the 50% fair price. We're also at the 50% fair price for the year and the month on the QQQ. And that is telling us that we found a balance area, not at the highs, but below that. And we can see the volume is higher on the down days. So this looks like profit taking at a quote unquote fair price. So I am not trusting buying into tech stocks. I'm not trusting buying into the S&P 500. And to add to that, leaving rates high means higher borrowing costs. With higher borrowing costs, we would expect those companies that are leveraged up, like the technology sector and the small cap, that means their borrowing costs long-term are going to remain high and they're going to have a harder time growing. Let's take a look at the CME Fed Watch tool to determine what we're seeing after the Fed meeting and what changes we've seen. So we're going to start out with July. We already know we had no rate decision today, so we have the July numbers that we're going to look at. And July numbers for the next Fed meeting shifted away from any rate cut to a 90% probability of no rate cut. Now, from a month ago, we went from 67% probability of keeping rates the same to now 90%. So we're absolutely pricing away the rate cut for July. I'd say 90% probability of no rate cut is pretty good probability of no rate cut. September has kind of stayed the same. We have about the same rate and probability of a rate cut, of one rate cut, as we did before, but it's gone from potential of 2 rate cuts, 17%, down to really a 60% chance of 1 rate cut. So despite the fact that the Federal Reserve said we're not cutting rates in 2025, the market is saying, yeah, sure you won't. They're still pricing in 1 rate cut in September. Now, it's still less because it was pricing in 2, but now we're only pricing in 1. And if we look out to December, assuming they were being truthful to us, they said no rate cuts possibly in 2025, and we look out to 2025 to December, and we still see that we're pricing in a rate cut in December. Sorry, let me do that. And 2 potentially. And even a slight chance for 3. So we have a 60% probability of at least 1 rate cut going into the end of the year. And arguably, we're looking at 24% chance of a 3rd. So very little chance of no rate cut based off of the CME Fed Watch tool and some of the data that we're seeing from the Fed Funds futures out into December. So the market is saying, you can say that, but we don't trust you. This is the time to get defensive, because if they do leave them high, that means borrowing costs stay high. They're betting. They're betting on the Fed to crumble and bet on 2 cuts, 3 cuts potentially by December, even though the Fed said no go. So that's a conflict. That's when we look for safety. Now, the general main areas that we look for safety, what do we look at? Utilities, healthcare, and staples. Now, utilities, I think, are a decent buy right now. They're holding up. They pay a high dividend. They're at a previous resistance, now acting as support. I think that's a reasonable place to set up a price pattern on a bounce off support. And if we do break through this high, we could easily see a 5% rally on stocks that pay a really good dividend. Some pay as high as 5% dividend, equal to or greater than what we're seeing in bonds. As we look at healthcare, healthcare has also pulled back in these moves, but it is appearing to set up for higher highs, higher lows. This little line through here, I'm looking at this as a channel support bounce. And if we bounce off there, we should be headed back up to 140. Now, I think you can find stocks inside here like Johnson & Johnson and Merck and not Procter Gamble and Abbott Labs as opportunities for price patterns. But the broad sector at 133 could go back up to 141. And that's a sizable bounce for a sector that is highly oversold and a clean target that will pay you about 7.5% in the healthcare sector. The one that's probably the most interesting to me is consumer staples. Consumer staples had a very strong resistance line that traded through here. It broke out, tried to go higher, and it went about 5% and then sold off aggressively down to 76. This rally created higher highs and higher lows. I don't see it selling off to the 76. I see it retesting this channel support and probably creating a channel in the meantime that is going to look something like this. And if we're capturing these highs and we capture these lows, we're approaching 80. If we bounce on 80, not only do I think we're going back up to about 83 to 84 for a 5% move, I think we could repeat all of this and be looking for a 10% recovery and growth in consumer staples. But what becomes even more attractive is looking at individual stocks inside of there, like Pepsi, who is highly oversold, can't seem to break through the support, which is a good thing if you're bullish, and pays a solid dividend. If we break through this high, about 133, not only do I think we're going to go for the $4 move, I think we're going to go from 133 all the way up to 143 up here. And we're looking for a $10 move. And even on the bounce, you probably could get $14 or more and get 10% plus a dividend paying stock that is highly oversold. Inside that same realm of consumer staples, I'd look at Kroger. Kroger is near its strong support level. I don't see this breaking through the lows. If it does, we'll get out quick. But the risk to the reward on this is a gap fill all the way back up to 72. If I can buy near 65 and trade it up to 72, we're looking to make about 12 to 15%. And the risk you'd have to take is only about $1 to make that $8 or $9 move. If you want confirmation, just simply let it break through the 20-day moving average or break through 66.50 on the way up. You might have to risk an extra 50 cents for it, but it's still going to give you a really high reward risk ratio to trade up to the next level. The only concern is pre-market on Friday, we do have earnings. So be aware of that. You will be able to look at this after the earnings announcement, and if we can buy closer to 64, even better. But I'm looking for that break of 65, 66.50, all the way back up to 71, 72. Now, outside of that, we talked about defensive being utilities, healthcare, and consumer staples. We'd also have defensive aerospace. This would be your ITA for the iShares U.S. Aerospace Defense. Now, it has already run like mad from April all the way up here. We've gone from 130 to 183. So to confirm this, the next move higher, if you want to play into those aerospace defense sector, those stocks, what I would be looking for is simply a break above these highs. We've pulled back from 183 to 178. We're looking at this as a temporary pullback. And to confirm, we just need a break above 182. Now, I'm not expecting it to repeat this. I am expecting it to repeat this. So instead of trading it as a massive run up and repeat, I'd say make it a micro bull flag, or what I used to call a bull flag in a stiff wind. We're looking for about an 8 to 9% move here. And that's going from this low, including the gap, up to this high, and saying all we have to do is break out of this flag that's going sideways, clear at 181, and we should be able to repeat that $17, $18 move and get 10 to 13% higher than that breakout. And that's betting not on one single aerospace, but the entire ETF. So there's lots of ways to play this market, even with this uncertainty. Tomorrow is a day off. As far as the market is concerned, we could get a lot of news, a lot of changes between now and Friday. Watch for Friday, read the news, pay attention to how those earnings play out with stocks like Kroger, and then we're going to watch for these price patterns to bounce or break to get us into the next trade in the defensive sectors and the aerospace defense sector as well. That's going to do it for me today. Have a fantastic day off in the markets tomorrow. We'll talk to you again on Friday.